again, we have until January, maybe February, maybe early March until we hit the next financial crisis, because we're almost out of dollars that were printed left over from 2020 and 2021. When those run out, we're going to see all hell break loose. And then the Fed is going to have to print like it never did before. And that is around when the dollar will die. I believe it will happen in 2024. The process will start once the spare dollars run out. And from there, we should see mining stocks finally make their monster comeback. It has been mind-numbing. It has been torture, but we're almost at the end of this.
Rafi Farber, founder of Endgame Investor, is a seasoned analyst with renowned insights into economic trends. Farber anticipates a financial crisis in early 2024 as the printed dollars from 2020 are exhausted, marking the start of the dollar's decline. Converting cash into physical gold and silver will be the most effective hedge against hyperinflation. The central banks will be powerless in their effort to control precious metals prices. The purchasing power of the US dollar has fallen dramatically over the last 110 years thanks to inflation and a sharp increase in the country's money supply, which grew by $3.8 trillion in 2020 alone. Farber highlights a record 4.5 million ounces of gold drawn from the LBMA and diminishing silver reserves, raising concerns about potential scarcity. As this happens, we see record monthly physical gold drains from the LBMA, and physical silver stocks in London are back down just above all-time lows. Meanwhile, Farber sees a stable historical gold-to-silver ratio, 14:1, during the 1922 and 1923 hyperinflation, hinting at a possible repeat if gold substitutes are dead. Silver has underperformed gold in the past few months. The gold-silver ratio jumped to $88, the highest point since March 2023. It has jumped by over 15% from the lowest point this year. In most cases, if the gold-silver ratio is high, it means that it is right to buy silver. Now we will present the clips of Rafi Farber's insights from his recent interview with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
A little bit about the gold to silver ratio in Weimar. How does silver behave in a hyperinflation? Well, we have here a constant gold to silver ratio from 1922 to the hyperinflation of November-December 1923. It stayed constant. You can do these calculations on your own. The first column here is paper marks. The second column is silver. The third column is gold. So if you take this from the third column, divide it by the second column, you get the gold to silver ratio. It's 13.95 all the way through, about 14-1. There's no reason why that will not happen again once the gold substitutes are dead. And look at this. We have a record gold drain for a month from the LBMA, the London Bullion Market Association, of 4.5 million ounces of gold, or at about 275 million ounces of gold left. This is a record for the month in gold drainage. And we have here another drainage of silver, not quite to record lows. I think it's about 8 million tons above record lows, but this is the first significant drawdown since December 2022. And remember, we have here in this little table here, this is the holdings for SLV and silver bars. So if you look at the London total here, I'm not sure if my picture's in the way, but I'll move it. It says 316,492 bars in the JPM London B Vault and 31,033 bars in the JPM London V Vault, both in London. So we take those bars together and we have 347,525 bars. And we have here from the LBMA itself, if you look at the bottom, in terms of silver, it says this equates to approximately 880,053 silver bars. Well, 347,525 of those bars, about 40%, belong to SLV. So the LBMA does not have that much silver left, and we could see a new record low next month. And finally, we'll go into the paper and physical divergence of gold. The blue line is the total amount of gold in transparent holdings and funds throughout the world. And we see here's the gold price. This is the first time since it looks like this trend began in 2021 that holdings in gold funds throughout the world have been dropping consistently at about the same rate since 2021, whereas the gold price itself has been rising. So throughout the world, in whatever fund it is, there's less interest in holding gold in paper funds and more interest in holding it directly, physically, in ways that cannot be accounted for by these statistics, which means privately held and not in these accumulations.
Farber references a historical chart comparing Dow, gold, and gold stocks, emphasizing that mining stocks surged following the mainstream market's downturn. The gold miners' stocks are lagging gold's strong young upleg, their gains falling behind. Their striking performance gap is undermining gold stock sentiment, leaving traders even warier of this sector. While definitely vexing, this anomaly has only arisen over the past couple weeks. Gold stocks' precedent during past major gold uplegs implies this will unwind soon, with miners surging fast to catch up with their metal. Farber warns that rising interest rates make reverse repos crucial for treasury auctions, but they may run out by February 2024, triggering a financial crisis. The reverse repo facility has come to be seen by many market participants and some in the central bank as a proxy for excess liquidity in the financial system. Inflows into the facility expanded rapidly when the Fed was aggressively buying bonds to provide stimulus during the depths of the coronavirus pandemic and its immediate aftermath, taking reverse repos sharply higher from nearly zero inflows in the spring of 2021. Let's get back to the interview.
I have this chart here, which I've shown before. We're going to look at it in a little bit of a different context today. When will miners finally rise? So we have a chart here from the late 1920s until 1939. It shows the Dow versus gold stocks. The Dow is in the black here. This is the bubble top in August 1929. This is the crash of 1929 here. And here is the bottom in 1932. Homestake Mining, the premier gold mining company back in the day, is in blue, and Dome Mines, scaled to fit, is in whatever this color is over here. Here is the gold price. It was fixed at $21 an ounce here, and up here was fixed at 35. So it doesn't really move much. So you have here the Dow, which collapsed into 1932, and the mining stocks, both Dome Mines and Homestake Mining, they did fall into the 1929 crash over here, and they did reach new lows just like the rest of stocks. But other mainstream stocks, the Dow, kept falling and falling and falling and falling as these two mining companies rose and rose and rose and rose. And when did they really start to rise? So they really started rising after the Dow bottomed out, meaning after all of the inflation was cleared out of the system and the monetary system was cleared out, and you had a tabula rasa, basically. So that is when the mining companies really took off, and mainstream stocks only gradually and recovered to the bottom of the October 1929 crash by 1937. And then there was another crash in 1938. The two mining companies here, they stayed at or near their highs all the way into 1939, probably beyond. I don't have a chart that extends beyond that year, but this is what we should expect, generally speaking, from mining stocks going forward. We have to wait for the mainstream bubble to completely deflate, which I think will happen after the next round of printing. When it all goes into commodities and the monetary system starts to go haywire, that is when mining shares will really start to pay off. And of course, they are still not as important as holding physical gold and silver with you in times of monetary chaos. The national debt is up $100 billion in 6 days. These are two tweets by the national debt tweet account. We are at $33.72 trillion on November 8th, which is yesterday or 2 days ago if you're watching this. Whereas on November 2nd, 6 days before that, we were at $33.637 trillion. So almost $100 billion in 6 days. If there are $1 trillion left in the reverse repo facility and the government intends to borrow $1.6 trillion by March, then the ground zero for the reverse repos for those extra spare dollars that were printed in 2020 and 2021, which are the only things that are funding these treasury auctions, they will zero out somewhere around January, February, maybe early March at the latest. And once they do, there will be no extra dollars to bid on these auctions. Why is it, one of my Endgame Investor subscribers asked, that the system needs reverse repos now but did not need them before 2021 when they didn't really exist? Well, the answer is because interest rates are so high now that other sources of money, of dollars that could come in and bid on these auctions will not, because they have to service high debt costs. And they cannot open up new loans because the costs are too high, which means the money supply is not expanding, it is shrinking. And in the environment of a shrinking money supply, interest rates have to rise unless the Fed buys the bonds directly. So yes, the reverse repos are the only source left that are funding these treasury auctions, and they will run out in around February, somewhere around there, maybe January, maybe early March. but they will run out, and then we will be in a financial crisis that is coming fast.
It's essential to recognize precious metals, particularly gold and silver, as reliable assets that possess intrinsic value, especially in the face of the looming threat of hyperinflation. Analyst Peter Krauth has a model that forecasts that gold's price will rise to $5,000 by 2030, which would drag silver's price up to $300. This is due to gold's use as an inflation hedge. Given the potential challenges to the dollar, how do you see the roles of gold and silver evolving in your investment portfolio? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.